Hello everyone, welcome to the third session with Cyril de Maria. I would like just to say that recordings from session 1 and 2 are available in the link that you have received already. And we can go right away to your questions from the previous sessions. Welcome, Cyril.
Thank you very much, Evie. Hello everyone. Today is about asset allocation and private markets. As promised yesterday, we can start with a Q&A if you want. Or we can go at the end as well, or you can also in the chat write ongoing so that we can answer the questions when they emerge. So is there any question at this stage? Feel free, really. For me, it's very interesting to answer questions, and it's very stimulating for everyone. So whenever you have one, don't worry, it's going to be interesting, and feel free to ask the question. So today is about asset allocation and private markets. I structured the presentation so that's me. I won't explain because we already had the chance. In 5 sections, a little bit like yesterday. I will complement a little bit what we saw in the first session, which was extremely dense. So it's going to be an easy start with a bit of figures, a bit of analysis of these figures. Then we will go into setting up a program of investment in private markets. And then I will introduce what do fund investors do when they actually do invest in private markets. So that's called the top-down and the bottom-up approaches. If you ever heard someone speaking in fund of funds or fund investor, they probably use this expression at one stage or the other, or one of the two. And then I will show some examples. The challenge of examples is that there is not much available for free online, which is public. So I took some. They might be more or less recent, but the great thing about them is that they are very illustrative of the result of this kind of programs and the constraints and the challenges. And then we will talk about something which is called the denominator effect, and something which by reconstruction I call the numerator effect, and hopefully it will trigger some questions from your side maybe. So let's start. I think the evolution of the markets has been very fast. If you look at private markets, and we discussed it very briefly, it actually dates back a long time, even before Christ, right? But we said that the professionalization of private markets as we know it has been more recent. We didn't give any date, and technically there is none really. But if you look at what were the milestones, first was the emergence of the notion of fund, which is dating back end of the 19th century in the US, more or less. Then you had the emergence of the separation between principals and agents, and the agents being the fund managers and the principals being the fund investors. This emerged over time in the economy and the financial world in general, but in private markets, you could see that somehow the first step was in the US after the Second World War, when one of the Harvard professors decided to set up the equivalent of the first VC fund, if you wish. His name was Doriot, and so somehow he created the idea of delegating and trusting to managers the creation of companies, and he would finance them, right? And at that time, he made a fortune out of financing the first private company doing computers. Of course, they were bigger than what we know now, but it was a bet which paid off handsomely. And according to some authors, the very first buyout was 1964, but the emergence of buyouts as we know them with the leverage, etc., accelerated over the course of the 70s and the 80s, notably thanks to the deregulation, which started in the 80s in the US and then later in the UK and the rest of continental Europe. Now, this kickoff unleashed a very significant wave of activity and innovation. So for a very long time, actually, private equity and private markets in general were below the radar screen. They were defined as a cottage industry. It's like everybody knew everyone. And when I started 20 years ago, it's not that I could have known everyone, but I would know the most, let's say, important players in the venture industry. I would know their name. I would know where they would work. And with a bit of time and effort, I would probably have eventually met them. And today it's impossible. There are much more players. The industry has grown so much. So as the industry grows, the buyers to meet some people grow as well, because there is only 24 hours per day. And one of the consequences of being bigger, faster, has been that the industry is not anymore below the radar. So what do I mean by this? Before, you would collect some money from an insurance group, a bank, a pension fund, and you would be a tiny, tiny portion of their overall assets under management. Then once we reach a certain threshold, then we're part of the asset allocation. And this has had a lot of consequences, notably that investors, when it's below, let's say, a certain threshold, they don't really look into it, or they do because they're professional and they have a fiduciary duty, but they don't change their mind all the time. As soon as you become part of the asset allocation, as we name it, then the wealth effect of the investors plays on you. So when they feel rich, they want to give you more money. When they don't feel so rich, they might actually stop or even reduce their exposure to you. And so one of the key consequences of that is that the industry, which was barely cyclical for a long time because we were very stable, because we were so small in terms of asset allocation, since the acceleration started in the 90s, especially with venture, but also buyout actually, and then accelerated in the decade 2000, 2010, then anytime there was a macro event which was affecting the providers of capital, so the fund investors, then we would see this boom and bust effect. And the worst part is that this is pro-cyclical. So if you think about private equity as an asset class which thrives on capitalistic changes, disruptions, movement, which is true. I mean, there is no bad movement in private equity because we can, as you saw in one of the graphs, we can come in at any step of the life of a company, and we are sitting at the border between the listed and the private world, right? So it means that when there is change, it's like, you know, pieces of a puzzle which are moving, or actually it's more like tectonic movements, right? You have these long-term trends and it puts pressure, and then sometimes it cracks, sometimes it moves, sometimes mountains emerge, etc. Well, in capitalism, it's a little bit the same. You have these long-term trends, right? It's pushing and frictioning, etc. And we're just here to observe and say, well, you know, we should move this piece here or this piece there, and then that's how we make money. But to do that, it means that you need to have a reliable pool of capital, and it shouldn't, let's say, be available depending on the circumstances which are generating the change. So at the moment, for example, we know that the movement is towards risky assets because basically there is low interest rates or even negative interest rates in some regions, some countries. So it pushes capital towards us. And of course, a lot of us are very happy about it because it allows us to do investments and to be active. But one thing we learned is that it can turn around very fast. As soon as the interest rates will start to grow again, there will be a reshuffling in asset allocation, and the riskiest part of the segment might see some receding tide in a way, and that's something we don't like. Because the second thing is that when you have shifts in asset allocation, this in itself creates the movement I was referring to earlier, and that's where you would need this capital to size opportunities. But if the tide is receding, then you might not be able to size the opportunities, and that's something which is let's say, a little bit of a burden. And of course, when the wave is going up, then everybody gets capital, so it potentially inflates the price of the asset. When the tide is receding, theoretically, the value of the asset should contract accordingly. And that's where you want to take control of this asset, because the valuations are attractive, and if you do a good job, then you will create value, and hopefully the tide will go up again, and then you can exit at that time, right? So the timing can play in your favor. The other thing which is very new is that we can trigger cycles. And that's very new because for a long time we were so small. The cottage industry doesn't move the needle in finance. But now we attract capital, and technically it means that we can trigger some events. It's not a systematic or systemic risk in a way like banks are, or maybe hedge funds are. We are not at this stage yet, if we ever get there. But the reality is that sometimes when you see that capital is attracted in a specific area, it triggers some macro changes. So what are they? Regulations, obviously. IFMD is a result of that. It's a recognition that the asset class is sufficiently significant to be regulated. And it's not only in the EU, it's also true in the US. It's a bit less true in the rest of the world because it's still very small, as we will see today with some figures in a few minutes on the slide. The other thing which is true is that it's a target for attacks. We saw that regularly when Mitt Romney was a candidate coming from Bain Capital, the industry was under the spotlight. When you had like a very significant bankruptcy like Toys R Us or Phones for You, the industry is in the limelight. And the thing is that, interestingly enough, a lot of players didn't realize that the context has changed, and they don't want to shoulder the mantle of fighting back, explaining. There is a bit this idea that if we don't move and we don't say anything, we might, live a longer day as a cottage industry, which is no longer true. I mean, whether we like it or not, we're not a cottage industry anymore. But nobody so far has taken, let's say, the courage to actually go to the media and explain the industry, really cultivate a relationship with the politicians and explain and this. Why? Because we're very busy doing deals, obviously, and also because these are small teams. So of course the professional associations try to do that, but it's not the same. It's associated with a good influence in a way, but also the lobbying can only lead you so far. There is a point where the key players have to take action and not only protect their own little interests, but more an industry interest. And so far, we didn't see that emerge, which is a bit of a challenge then going forward, because eventually things are going to happen regardless if we're here or not. I mean, you can try to avoid regulation, but at a certain stage it will arrive, and so you can help shaping it. And I cannot help thinking, for example, that we could have avoided IFMD because honestly, it doesn't bring much and it's a massive burden. But there was a kind of implicit reasoning behind it, like if we really hide and close our eyes and don't move, nothing will happen. Of course, there was a calculation from the largest players as well, which is that regulation favors us because it creates barriers to entry to the small ones. So there is a premium to the incumbent players with grandfather rights and basically, it attracts more capital to the larger ones. So regulation somehow favors the larger players. So they have no incentive to really fight it back. The second thing we observed is that there used to be a wide panel of sources of capital, and that was very healthy. If you look at the figures from Invest Europe, when it was still called EVCA, European Venture Capital, Private Equity and Venture Capital Association, and you look back the old reports, you would see that there was a kind of 1/3 of cash coming from banks, 1/3 more or less coming from insurance groups, more or less 20 to 30% pension funds, and then a small delta would be the rest, like endowments, sovereign wealth funds, etc. This has changed dramatically. Banks more or less are gone. There are a few exceptions. In the US, you still have Goldman Sachs, which is still very active. In Europe, you still have the cooperative banks, mid-size, small size, which are still active. But besides that, all the Morgan Stanleys, JP Morgan, I don't know, I mean, HSBC, all of that went out. And the empty space has been filled by what? Essentially pension funds. Pension funds have been swooping in. And the reason for that is that there there is a difficulty to generate yield. It's going down, and the pension years live longer, and so you have a shortfall to try to compensate for. And the good thing about private markets is that it generates theoretically performance, which is supposed to help you catch up, because bonds don't deliver, and listed equity returns are tendentially going down for a lot of reasons. So they were the ones getting in, but we will see that for Europe, for example, that's a challenge, because we have a mix of pension fund systems and social security systems. So if you go to Italy, Spain, France, and Germany, there are a few pension funds for lawyers, notaries, and all these professions, but mostly the bulk of the people depend on basically the social security system. So of course you have the UK, you have Ireland and Scandinavians, Netherlands, etc. These are pension fund systems. But here, what appeared is that you had a shift from defined benefit to defined contribution. And this shift has had a lot of consequences, because defined benefits are much more easier to allocate, because basically it's a pot invested for the collectivity for the very long term. And defined contribution means that you have individual accounts, basically. And so when you shift from one employer to the other one, you need to get your cash out and then bring it to the next employer, who can reinvest the pension for you. But the fact that you need to cash out at unpredictable times doesn't reconcile with the duration we've seen yesterday, which is these 3 to 5 years. So getting liquid fast is a problem in our asset class, as you know. So the pension funds are, let's say, taking over somehow. But the problem is that Europe depends on a very specific number of them, which is not covering the whole area. And the second thing is that the model is not necessarily adapted. As we will see today, also sovereign wealth funds and a few other sources have been stepping in. But the fact that we depend so much on pension funds creates some sort of systemic impact. And in particular, as we know, pension funds have this allocation where we say we put X% in bonds, X% in stocks, X% in alternatives, and within there in private equity, private debt, private real assets. The problem when you think along these lines is that, as we will see at the end of this session, if one pool contracts very fast, very heavily, then the rest relatively looks bigger. And so when you had the 2008 episode, when the equity prices sank by 40, 50% or more, then it means that your allocation to equity virtually declined by half, let's say. And so the rest correlatively increased, because we measure in percentage. And then suddenly you look as if you were over allocated to private equity, which forces you to do what? To rebalance, which technically is a good idea, but in practice very difficult to do. And second, since you're over allocated, and if you don't have any margin room for interpretation, then it forces you to sell on the secondary market that we've been discussing briefly in the first session. So that's a problem, because it creates some sort of contagion from one aspect of the financial world to the rest of the financial world. And as I said before, we were below the radar. Now we are on the radar, so we suffer from the consequences of that. The third element, which has changed dramatically, and we shouldn't underestimate that, is the emergence of what we call secondary transactions, as in there was one and there is a second one, especially in buyout. So you can go through, as a company, from A selling to B being an LBO fund, right? And B might sell and to C, and C might be another LBO fund. This is called secondary buyout, which has nothing to do with the secondaries on the fund stakes or when the funds are running out of time. That's another form of secondary. And so this has changed a lot. I already explained on the graph the fact that when you have dry powder and residual value, which is worth now 4.5 trillion, I said some of the dry powder actually will be used to recycle the assets in portfolio so that they stay. So when B sells to C, the asset transferred from B to C, but actually in the graph, in the stat, it stays in the bar of the residual value, if you wish, okay? And so this is changing a lot of things. It's changing the way we price assets, because before we depended heavily on the comparison with the stock exchange. Now you have data points which come from, oh, base B sold to C, and we can maybe observe the price. And then we can observe a discrepancy on this specific transaction with the listed assets. So it creates a new referential for pricing assets and the dynamics of pricing. The other thing is somehow ultimately we might see a kind of specific framework which would emerge in private equity, where you can price your assets differently than just comparing yourself all the time to the listed stocks. And the reason for that is, of course, that the stock exchange is shrinking, especially in the US. So the number of observable companies being priced is reduced, and the companies which are listed are usually conglomerates. So it's much more difficult to compare yourself with something which is a mix of so many different activities. Whereas if for some reason we have more data coming from the private market, well, then we might refer more often to this transaction framework. And now you understand the importance of data with all the limitations we've been discussing at the end of the session yesterday. But it doesn't mean that it's going to stay forever like this. There is so much pressure to get high quality data from the industry that eventually it might come from an effort from the industry, or it might be that someone somewhere will step in and say, now you're forced to disclose for a certain number of reasons. So we might see that more. And then that might impact significantly the way we do business and we price assets, because as we said from the very beginning, this is one of the key features of the non-listed world, the difficulty to price assets in a context of lack of information and asymmetries of information. The fourth aspect we've been discussing, so I will go faster, is that we mark to market the portfolios with some limitations. So the guidelines are very well written, actually, and it's a collective effort from many, many professional associations. It's called the IPEV, International Private Equity and Venture Capital Valuation Guidelines. They're available for free. They have their own website, and they have been revised, to my knowledge, in December 2018. But basically, they explain to you what are, by declining order, the valuation methods that you should use to value, when they're in your portfolio, private assets, and namely, because it was designed for private equity, private companies, right? So it doesn't solve your problem if you're in private real estate or in private debt, because unfortunately, it's much more challenging to do this kind of thing. But it gives you some ideas, and maybe you can adjust it. And so this is, of course, a game changer, because as we said, the value of unrealized assets might be more or less volatile in the future, because we have to market to market. And the first method that they recommend is comparing ourselves with something that we know the price of, namely listed assets, right? And so it's going to introduce artificially some risk in our portfolios, at least if we measure risk through the variation and the frequent variation, even though it's quarterly, the frequent variations of the value of assets. And so this is still in the making. We are going to observe what happens when we have significant crisis. But so far, the mark-to-market was implemented in a benign environment, because it was essentially after 2008. So in the run-up, where stocks were more or less always going up, with a few plateaus and corrections, but mini corrections, not significant. It never really affected us, because you need a correction which lasts over multiple quarters. So that I will show you a graph on, at the end of today, showing you this impact. But so far, it never really happened that much. So,
Cyril, excuse me.
Yes.
We have a raising hand. I think someone has a question for you.
Sure.
Hi guys, this is Vahagan. I have a question regarding a common practice that we see more and more, funds that are selling an asset from one fund to another within the same fund manager. And I would like actually to have your point of view on this. I don't know, perhaps the operational rationale and the tax rationale behind this practice. Thanks.
Sure, that's an excellent question. Thank you very much. So it's a very rich question. I will take at least 2 to 3 minutes to answer to the best of my knowledge, because unfortunately you identified a section where, and it's the tax part, where honestly I don't know. But the rest I can go into it and we can discuss it. So I think it was yesterday or the day before, we discussed the idea that sometimes when a fund reaches the end of its lifespan, there are still some assets in portfolio. And we said it's possible to continue, even though it's not planned in the fund regulation, in the limited partnership agreement. It's possible to sell it for €1, but nobody likes that, right? It's possible to try to sell it on the secondary market, but then you have to take a haircut, which is less than selling for €1, but you might lose 50, 70% or even more of the value of your asset if it's a complicated asset to sell. Now, the point you're referring to is called GP-led restructuring, if I'm not mistaken. So the idea is the following. The fund manager knows that when you reach year 8 or 9 of a fund, you should almost see everything going out, right? But sometimes you have very good assets or so-so assets, but not bad assets, which are in the portfolio, and you know that within the next 1 to 3 years, it's going to be a very big challenge to sell them. And you know that your investors don't like extensions, which are going far beyond your initial lifespan. So what you could do is then say the following. Look, I'm going to offer a window for investors to get out of the existing fund, okay? And to do that, I will create a little brother or little sister of the existing fund, okay? This little brother or little sister, the only purpose of this fund will be to buy the asset of the older fund, right? So you transfer from fund 1 to fund 1A or 1B or whatever you want to call it. So the investment period basically lasts 10 minutes or 1 minute or 1 hour, whatever. But there is no other investment period. We're not going to do new investments. Now, the logic behind this, and I try to answer your question very precisely, is that the fund manager is in control. That's the first thing. The second thing is that the control means that you control the information as a fund manager, which is crucial because of confidentiality issue. The second thing is that existing investors can choose to cash in or to be transferred into the 1B or 1A. I don't remember how we called it. So you have really the choice. I want my cash now, or I want to continue. And if you want to continue, it's fine. So you get transferred from 1 to 1A, let's call it like this for simplicity purpose. If you want to cash in, it's because there are specialized investors, secondary investors, who will step in 1A, and then they will give cash to step in 1A. And you're going to use this cash to give it to the ones who don't want to be transferred from 1 to 1A. Now, what's the incentive behind all of that? It's because the transfer is done at NAV, to my understanding and my knowledge. It's an emerging practice. It's not very well documented yet because it's emerging. You have a lot of different ways to do it. It's like co-investment, if you wish. You have so many different forms of co-investment programs. So GP-led restructuring, I talk with practitioners, but everyone has more or less its little recipe, and it's very difficult to overly generalize until industry best practices will emerge, which they usually do, and then we will have a clear view. But so far as I understand, we transact at NAV. And so for the ones cashing in, it's better than selling for €1 or at a significant discount. So it's motivating. And if they think that the NAV is too low, then they can always continue and be transferred at no cost normally in the 1A, right? So the logic is really to offer this window of liquidity, knowing that investors will be happy to have the choice. Sometimes they hate it because it pushes them to be in front of their own responsibilities. But more than often, investors are happy, especially if they need the cash, for example, to reinvest in your next fund. And the new investors coming in know the fact that the valuations tend to be conservative, as we said yesterday. So the deal for them is still very attractive. It's not because someone cashes out that all the value creation is taken off the table. Certainly not. There is probably a very nice runway, probably with a shorter period of time. So you don't create 1A for 10 years. Okay. I don't know for how long you would create it, to be honest. Top of my mind, I would assume 5 to 7-ish years at best, at worst. I don't know, it depends how you see it. But the idea is really that when you get in, you still have some run up and you can get a very nice return on that. Okay. So that's a little bit the philosophy. Tax wise, well, obviously, if you make a profit, you will be taxed if you're taxable. A lot of investors, like pension funds, are not taxable, which is actually why they're so cautious about the type of inflow they receive. They shouldn't receive dividends or interest. They should receive capital gains because it's easier to show to the tax administration that it's not taxed. And also dividends are taxed at the source, whereas you need to recoup the taxes, etc. So that's one thing. And so if you are a pension fund and you're in one and you don't want to get in 1A and you get cash and within that you get some performance, it's fine. It doesn't change your tax status. If you're transferred from 1 to 1A, it's also fine because it's a continuation and you don't pay taxes on that, right? So it's much more complicated, of course, if you're a high net worth individual or a family. And honestly here, I mean, there's so many different scenarios and I wouldn't know how to answer the question about this part, unfortunately. I don't know if it answers your question.
Yeah, thanks.
Super, thank you very much. What I wanted to show you then is a bit of perspective on these figures. Often I get a question from clients who can be fund managers or fund investors, since I serve the two sides. And they ask me, what is it going to continue? You know, it's been growing at very fast pace, and it's true. I mean, hedge funds used to be much bigger than the asset class that we're talking about, and now we overtook them as private equity, but as private markets, we're even larger than the hedge funds industry. And for my colleagues who work in hedge funds, it's a shock. You know, they didn't expect that at all, because for them, liquidity is what matters. What they call liquidity is what matters the most, and they used to deliver very good performance, which is not necessarily the case so much at the moment, but it's a bit of a shock. And often they're like, yeah, you know, it's going to collapse. Basically, we're going to go down the drain, just like asset allocations in hedge funds have been suffering over the course of the last decade. I'm not so sure. I'm not so sure, and it's related to these four phenomena here. But let me use my laser pointer that I listed here. So, according to some estimates, notably from our friends at Prequin, we should see an increase from 4.5 trillion to more than 9. Now, you might say they're particularly optimistic. Actually, believe it or not, when Prequin did the predictions for, I think it was 2019 or 20, their predictions were below the reality that we observed. And that's despite the COVID thing, okay? So when they make a prediction, you can say, well, you know, they're always pushing it. It's no. Actually, I must have said, I was very surprised to see that they were more conservative than the reality. I'm not saying that they're going to be right with the 9 trillion, but if you really think about it, it's achievable. Why? First of all, you have new entrants. And of course, you might say, but you know, pension funds in the US have been investing forever. Canadian ones even more, because now there is even what we call the Canadian pension fund model, which somehow exists, which is a lot of direct investments or co-investments instead of going through funds. And then you have like the European ones, and basically everyone invests there. Yes and no. First of all, emerging markets for a long time, that was forbidden. Used to give lectures and trainings sessions in LATAM, and often, you know, their pension funds, like in Mexico, it's only recently that they're allowed to invest, and they can only invest, for example, through listed private equity structures, which are called CKD. It's the same for Brazilian pension funds, Chilean, Colombian, and it's a significant pool of cash. So it's only recently that they started off. The largest investor in the world is actually the Japanese social security system, and they were allowed to invest only in 2017. And they want to allocate I think it's 5% top of my mind, and they manage more than $1 trillion. I would say something stupid now because of the exchange rate, but top of my mind, it's 1.5 trillion. But deploying 5.5% of 1.5 trillion is going to take you many, many years because you want to avoid over-investing at the peak of the cycle. You want to diversify across time. And so just this alone is a massive pot of cash. But then since the social security system in Japan decided to do that, you have Japan Post, and then you have a lot of Japanese institutions say, well, you know, they're trailblazing. We should follow because actually the returns from bonds and stocks doesn't serve us anymore. So these new entrants, we tend to ignore that, but there are still some institutions which are prevented to do that. The Norwegians with their sovereign wealth funds decided to avoid private market except infrastructure renewables. So windmill farms and this kind of stuff. But they manage more or less 1 trillion, you know, depending on the exchange rate. And so if they go one day with 5%, you can do the math very fast. You will see the massive pot that they will have to allocate to the asset class. And this starts to pile up. I'm not even mentioning the fact that African countries start to have pension funds now, like Botswana. Of course, you might say it's a small country. Well, yes and no. I mean, it starts to, you know, accumulate over time. These are young populations. They are going to save a lot for their retirement. And I'm not even mentioning the fact that the population in China is aging, and ultimately they will have to have a pension system. It might be a social security system, like in Japan, with a mix of maybe third and second pillar, or it might be a purely private, I don't know, or a mix. But eventually what we observe is that even the social security systems now, because there is such a high life expectancy, they start to be a hybrid. And the clearest example is probably France. France has a social security system, but there is something which is called Fonds de Réserve des Retraites, FRR, which is actually, believe it or not, a pension fund, which is working for the social security system, investing in private markets notably. So these new entrants are still around, and we still have to talk about all the other Asian countries which have a young population and still getting equipped with a pension system. Then you have the fact that assets under allocation are growing. And so even if you stay stable with your percentage allocated to private equity, if the asset base is growing, then in absolute value, it's growing as well. And then you have the fact that a certain number of players are increasing their assets. And here I have a few examples in this graph. So of course, you might argue sometimes it goes down. Insurance groups went down from 4.2 on average to 3.6. Okay, but as I said, if insurance groups collect more assets, it doesn't mean that they have been shrinking. It's just it accelerates or no more, or it's stable. But others have been increasing, like public pension funds, but also sovereign wealth funds, as you can see. These institutions allocate more. So even if we assume that their basis of assets under management doesn't grow anymore, the fact that they shift from, for example, fixed income to private debt or listed equity to private equity means that technically it's going to fuel the assets under management. And then there is something which is called the threshold effect. That's a little bit of a theory of mine now. It's not documented necessarily by academic literature, but when I looked at endowments, I looked at it very seriously because there is this thing which is called the endowment model, and it was a bit of a puzzle to me. So I wanted to dig into it. And the fact is that there is no endowment model as such, or if there is one, it's a boring one. There is a Yale endowment allocation, which is what usually people refer to when they talk about it. But this Yale endowment is a very specific animal. They have 28 billion under management, and they have been investing in private markets for at least 20 years, if not more. And they allocate around a quarter, if not more, of their assets to private markets. Now, what I observed when I looked into that, and it's a coincidence, is that there are threshold effects. If you look at the Nakubo website and the allocation of endowments, you will see that below 100 million of assets under management, they barely allocate to private equity. And then as soon as they cross this threshold, then they start to allocate more. And then there is another threshold, which is 500 million, and then 1 billion. And the reason for that is because I did the math. it's not economically viable to allocate to private equity below 100 million because you simply cannot diversify properly, and you don't have the resources to pay an expert to help you build your program. But above 100 million, if you look at how much does it cost you versus how much can it give you back, then it starts to make economic sense. Of course, you cannot allocate a lot, I understand that, but if you build a program with maybe a mandate or well, it might be tricky because mandates usually 25 to 30 million, but if you can allocate to a series of fund of funds and maybe, you know, optimize that a bit with some co-investment program, then you might be in. And then beyond $500 million, you can even recruit full-time officers to help you allocate to maybe funds if you really want to go down that route. So these are the threshold effects. It means that some institutions which would be allowed to invest are not doing it yet because they don't have enough resources. And then as soon as they do, then they start to step in, right? It's a very interesting perspective if you think about it, because it means that we don't really have the same picture that we think we have, in the sense that the reality is much more complicated. It's also because when we think about asset allocation, normally you think that everything is scalable. Like today I can buy 1 unit of S&P 500 or 10 or 100 or 1,000, right? It doesn't change much, actually. It just depends how much cash you have. But there are some asset classes which are not that scalable, and private markets are one of these. So you cannot put €1. No, nobody is going to accept that. But if you have a certain amount of capital, then you can start to really allocate seriously about it in compliance, especially with your fiduciary duty if you represent the money of someone else. I wanted to show you some figures now. It's not particularly interesting to discuss the figures themselves. It's more interesting to understand the trends and dynamics behind. One interesting thing that I observed, and maybe you will see it with me. I'm just moving the windows so that I don't, I don't lose the chat window, but at the same time I can comment my figures. What has changed over time, and that's a bit fairly new, even though it's not that much of a clear trend yet, is the fact that you have a certain number of funds. As you can see, these are the dark blue bars. Let's use my laser, and you see that there was a peak here, right? And it's going down. That's very, very interesting, I think, because it shows that it's not only about COVID. There are some cycles which are either related to the macroeconomy or which are endogenous in the asset class. The other thing that you can observe is the aggregated capital which has been raised that specific year. We have to be careful because sometimes you have a discrepancy in the dates. I think I mentioned that briefly, but it can be that you raised your money in 2007 and you closed in 2008, which might explain why sometimes the volumes are unusually high in recessive years and can be unusually low in recovery years, like 2008 and 2010 here, okay? But besides that, you see that the amounts didn't peak in 2007 and they continued to increase until last year. Then of course you have the COVID impact in 2020, so it's more difficult to comment on that, which is why I wanted to emphasize with you today on 2019 on this specific slide. What struck me is that for a very long time, the industry was about finding the best fund manager in the niche which you consider, like venture capital, biotech Europe, VCIT West Coast, VCIT Texas, VCIT East Coast, or I don't know. You get the drift. It was like this, and what I observe now is that there is a kind of overwhelming work to achieve that. What do I mean by this? It's easier if you're a fund investor to actually allocate more to a lower number of fund managers. And that's been a trend now for quite some time. It has significant consequences for the industry. First of all, the value of the brand has been increasing dramatically. And that's why now you see that there is this umbrella brand, and then you have like vertical teams below. And the reason for that is that it's easier to have one point of contact at this massive brand which would then dispatch your request and communication with the vertical teams below. Some fund managers have been very good at developing that, and others a little bit less. The biggest challenge, obviously, is that the fund managers are fund managers because they want to maximize their utility, so maximize their income. If you're under a brand as a vertical team, you give up some of your economics for that, and a significant share. So of course that triggers the question: if you're the best in your niche, why would you go for a brand? And that's always been the arbitrage. You might have one flagship strategy which has built the track record and the reputation of the brand, and then you have like additional strategies, but these ones might not be the best in their niche. They're just teams which are okay, and they just plug themselves to the brand to get the machine in terms of fundraising, branding, operations, compliance, and all of that. But the consequence is what? The consequence is when you're a brand, you don't do small stuff. If I don't want to give names because I don't like to point out, and I have nothing against any of the big names in the industry, certainly not. If I'm one of these listed groups that we discussed some time ago, I won't fund a team which wants to raise 100 million. Now, if you think about the consequence of this for a second, you will see that this is going to introduce distortions of the market. The opportunities are a pyramid. At the bottom, you have a lot of opportunities, small buyout, lot of opportunities, venture, early stage, lot of opportunities. And then when you grow in the pyramid, you will see that there is only one Unilever. There is only one Kraft. There is only one, it's Heinz Kraft, sorry. Only one Roche or Nestle, Microsoft, etc. Right? And it's the same with buyout. So when you're in large buyout, you have a pool of opportunities, but it's much smaller than if you go for small buyouts, right? And in mega buyout, which is probably the realm of, let's say, 20 players in the world, the number of opportunities is actually fairly limited. Now, if you think about it, and you realize that the size of funds is correlated with the size of the transactions, and you plug it to this, it means that as the brands collect only large amounts for large strategies, then it skews the market upward. And it means that the competition increases at the top of the pyramid and tends to decrease at the bottom. This is going to have a lot of consequences, of course, on brands, because the returns are going to decline. If there is an excess of capital at the top of the pyramid, then necessarily you have an inflation of the valuations because of the competition, and then this is going to put a lead on the performance and put pressure downwards. You would argue that they will move back to going to the small buyout world, but no, because it's not the same skill set. As many fund managers would tell you, it's the same amount of work to do a small or a large deal, but the compensation is much nicer at the larger end. So why would they go back to small? So it's interesting because this graph, if we assume that 2019 was representative of a longer trend, it might create, if you make a heat map of the private equity market, you might see some areas which are red flashing like excess. And you might have other areas which are flashing actually lack of capital. So we might see some sort of distortions going forward, and it's going to impact, of course, the overall picture of the performance of the asset class. And remember, when the press talks about us, they focus on the most visible, and the most visible is large and mega buyout, late stage venture, and this kind of thing. So they tend to over conclude and over generalize their conclusions. They don't understand that the market is actually compartmentalized, and what is true in large and mega buyout might not be visible at all in the lower mid or in the small buyout world. And that has consequences because regulators read the press, they're sensitive to what they call the public opinion, even though actually we don't really know what people think about buyout or venture. And so this will have a chain of consequences and reaction that we need to keep in mind and observe. And sometimes we need to actively communicate to the market to correct some misconceptions. The other thing I wanted to show you, and I think it's quite interesting, is that for all the talk about emerging markets, it's still very much, oops, sorry, actually, I work on Apple, and so the layout has moved a little bit, sorry about that. But basically, it's still very much a developed world market. Why? Because of leverage buyout. Leverage buyout is largely dominated by the US and Canada, so let's call it North America, and Western Europe. And so because of the volumes, it means that it's still very much dominated by that. Of course, in number of deals, you will see that the rest of the world contributes more, especially because they get more venture and growth capital operations, less leverage buyout because leverage there is unaffordable because of very high interest rates in a high inflation context. So you still have some buyouts, of course, and I would assume even in emerging market, but not necessarily leverage. And maybe the amounts are a bit smaller, and also the frequency of this large transaction is also very less frequent. And so that's why it still appears that it's mostly North America and Western Europe. The big change, obviously, is that when you have a crisis, you see that the ones which suffer the most, and that's unfortunately true, is emerging markets. Capital flight is a real phenomenon there. So when I complained earlier about the pro-cyclicality with the very first slide of our asset classes on the radar screen, it's like someone complaining about a problem that someone else has been experiencing for a very long time. And emerging markets are the clear victims of the pro-cyclicality because it's very difficult to source capital locally, even though, as I said, local pension funds are emerging, but they're very slow because they're very conservative, and I don't blame them. They're very slow at allocating to alternatives. So they want first to do the traditional 60-40 or maybe 60-40, 35-5, but they don't necessarily want to overly diversify. And if they do, they want to take all the precautions, which you know their natural, let's say, mood would push them towards. And so because of that, it means that in 2009, if you look at the proportion of rest of the world, and that includes Asia versus developed markets, you see that it has been compressing massively. Having said that, it's better than 20 years ago because it would have completely been wiped out. So now there is, because of the asset allocation, there is a minimum which is still there, and it's still feeding into the emerging market. So where does the money come from? What we call DFI, Development Finance Institutions. So this is part of it, like EBRD, CDC, or Actis, as it's called now, and Proparco, and all of that. So that's where the money comes from. But it's still very pro-cyclical because private sources tend to dry up. Emerging markets are perceived as more risky than developed ones in crisis. They're a little bit, let's say, on the background. So here I will comment on something which I already mentioned a bit, but just as a summary. So the shifts are really about this new institutions which are getting in. That's the social security system of Japan. The other thing which investors are thinking about today is that, yes, we have been going through brands, but then there is a problem, which is concentration. And I mentioned the blow up with the largest fund manager in Middle East. That was a big shock. People assume that since it's so big, it cannot go wrong, right? Or go bad. And actually it did. And now we start to rethink, should I put all my eggs in the same basket in a way that it's only with one fund manager or two or three? But there is a rethink about that. But then going out of that is very challenging. First of all, because there is a huge competition to get into funds. So it's not because you want to diversify that you will be able to do that. And then there is, of course, much more work, much more intensity to get in more fund managers. And then you demultiply your reputational risk if you demultiply the number of fund managers you work with. So there is this tension between, should I go for a limited number of fund managers and get special treatment and get the brand, which protects me somehow? Or should I go for diversified optimizing my returns, but higher effort and still a reputational risk if I choose a fund manager which is less famous and blows up. The other thing which is very clear is that there is a fragmentation. When you talk about asset allocation, you assume that everybody is treated the same. But it's true, as we said yesterday, if you invest in a private equity fund. But the fact that you have more mandates, segregated accounts, co-investment programs, etc., it means that this unicity of treatment tends to disappear. And that has consequences on your asset allocation. Often you will read the academic literature and they're fairly ignorant of the reality of what happens on the field. And one of the things they tend to ignore is that who you are matters. And they would, for example, say, oh, we got access to this co-investment program from an unnamed source. And we could see that it makes sense to make co-investment. And I'm like, well, it depends. Whom did you look at? If you look at a Canadian pension fund, which has like a staff of 50 or 60 people, it's different than if you look at CalPERS, which is notoriously understaffed and under-resourced to do private equity, which is why they get criticized all the time. Then if you look at the Canadians, they're going to do very well. And if you look at CalPERS regularly, they don't do so well. There is a high turnover in their staff. Recently, again, they had to change their CIO. And then you might conclude nobody should do co-investment because it's really bad results. Well, no, it depends who you are. And it depends your format and the way you negotiate it, which is what we're going to discuss now in the next hour with the following slides. Before that, I wanted to finish this slide. So what we observed since, I would say, the top of 2017 that you saw in the previous slide is really clearly a refocusing on developed markets, which is very interesting because you would assume since the market is going towards higher risk and equity-like returns, they would continue to go towards emerging markets. So first of all, there were some tensions politically, and politics, as soon as you're on the radar screen and part of the official asset allocation, it impacts everything. Perceptions of trade tensions, perceptions about political dynamics between trade regions, etc. It's affecting us. And interestingly enough, it retreated capital from emerging markets, which seems to be vulnerable, towards the US and the EU. And that's quite visible at the moment. The other thing which is very clear is that the balance of power is shifting, and it's been shifting for a while now, again in favor of fund managers. Right after 2008 to probably 2012 and 13, it was quite clear that the balance of power shifted a little bit more in favor of fund investors. So you would get better terms. For example, some of the fees that the fund manager would collect from the portfolio companies would be offset from the management fees. So offset means you reduce the management fees from the amount that you collected directly from the portfolio company. For a long time, the fund manager would get the management fees and then would charge some board membership fees to the portfolio companies. Now, the rule is that normally, well, the best practice is that normally you get this amount and you reduce either by 100% of the amount, the management fees, or 80%. According to the latest statistics, it seems to be that it's 100% the most frequent case, but historically, to still foster some form of alignment of interest, you would only offset 80% of these fees to the management fees, so that the fund manager would still be incentivized to actually collect the fees from the portfolio companies. But after this episode, even though we didn't retreat back from the old system on the fee offset, you could see that the terms have been shifting in favor of the fund manager. So the pressure to reduce the management fees is no longer true. Actually, we have even seen that some fund managers started to re-increase them a little bit. The fact that the hurdle rate has been eliminated from some fund regulations is another proof that the fund manager has a lot of power, because that's one of the few mechanisms that we negotiated as fund investors, which would somehow foster alignment of interest. And the other thing which is very clear is that at the larger end of the market, it's really a lot of management fees which are collected. And that triggers the question, of course, about alignment of interest with fund investors, because we're here for the capital gains. What you have to remember is that when you build a brand, like the ones we know, and I don't have to name them, there is a very little incentive to take risk. So if you think about risk-return profile, you know, you have much to lose in terms of track record if you have a very bad deal. So when your team comes to you and says, this is the deal what we should do, there is always in the back of the mind of the boss, who is usually a very senior individual, usually it's a man, should I do it or not, knowing that we have patiently built this machine which manages multi-billion-dollar funds now. So that's also a source of concern. Also with age, you're less keen to take risks, even though you might say they're still bright and brilliant, that's probably true. But the natural tendency of the individual is to reduce the risk profile of the investment with age. And since the younger generation is pushing for it, but doesn't have the power to decide, and it's a collegial decision, then there is always this question mark, are they still chasing the deals that made their fortune before? That's something I leave it to you to think about. The last thing is that the regulators are stepping in. So earlier when I said about the fee offset, basically it was driven by the SEC. The SEC probably got complaints from fund investors who cannot officially complain to the fund managers, otherwise they might be kicked out from the next fund. So what happens now is that fund investors go to the SEC, and the SEC looks and then investigates. So the SEC looked into club deals in 2007 and launched some potential preliminary antitrust process to the point that club deals more or less disappeared today. It was replaced by co-investment programs because teaming up with your investors is not anti-competitive, whereas teaming up with your competitors is potentially. The SEC also looked at the cost and the fees charged to funds, and often it's not very clear, and the SEC has taken a hard line. So they say if it's not mentioned, you shouldn't charge it to the fund. Whereas before there was this idea that you could interpret the provisions of the fund and put some costs which are like, you don't really know if they are like manager costs or fund costs, you could maybe push them to the fund. The SEC has been looking into that. And in particular, it's under the pressure of the SEC that there is this fee offset, which has more or less been generally adopted. But it went to the extent to look into, for example, consulting services which have been provided to portfolio companies. And the SEC looked into that and said, well, that's actually a revenue you derive. So actually, technically, could even be an offset, right? So they really are taking a hard line. So it's not that the US are regulating more. It's more like the regulator takes the existing regulations and has a much more literal interpretation and tries to protect more the fund investors. Is there any question? We're already halfway through. No? Feel free. Again, I'm here to interact with you. So let's have a quick look at how do we set up programs. The logic of integrating private markets is to enhance your portfolio construction. So as we said yesterday, you have duration, risk, return, and we are sitting at the corner, which is higher risk, higher return. Regardless if we talk about private equity, private debt, or private real assets, we are here to transform assets and to generate capital gains. The other thing is that we know, but we cannot know how much. We are partially uncorrelated with the listed wealth. It's not very clear because it's not stable over time, and we still compare ourselves with the value of listed assets. So there is a connection. You cannot say that you apply the multiple of comparable method to value your assets, and then you're completely uncorrelated. That doesn't work like that. When we get in an investment, we compare ourselves to the stock exchange. When we get out, we compare ourselves to the stock exchange to price the assets. So somehow there is a link. The difference is that, first of all, we might create value differently than how value is created on the stock exchange. And the other thing is that the investment strategies can be counter-cyclical. So it's not that particularly clear. For example, distressed debt works very well when everything else falls apart. So that's why it's valuable to integrate it in your asset allocation, because you have one strategy which capitalizes on crisis and disruptions. Okay, so that's why it's very difficult to quantify, and any attempt by the academic literature for me has been inconclusive, and that's why nobody talks about it. The other thing is that what is challenging is to select the right fund manager. But if you can do that, and you have established a viable pool of fund managers, then you can really significantly improve your performance. And the clear case that I already mentioned is, of course, Yale, but also other endowments who have been quite successful at selecting very good fund managers and then pushing up their returns. How do we know that? Because the endowments in the US communicate on their results. So we can really look not necessarily into their detailed portfolio, but the fact that some of them do better than others. The second thing, which is quite important, is that private equity technically enlarges your pool of investments. What do I mean by this? You can go in countries which don't have a stock exchange, for example. You can invest in sectors which are not represented on the stock exchange. They can be traditional sectors. I mentioned funeral homes, but it's of course deep learning. It can be big data. It can be basically every emerging sector that you would think about, which is not yet represented on the stock exchange. And then, of course, we can invest all along the life cycle of the company, whereas the listed markets tend to focus on growth and maturity. They don't really cover emergence, and they don't really deal very well with restructuring, right? So if you start to build your portfolio, you can plug somehow strategies which start to work when the rest is suffering. And that's also an interesting perspective. So that's the strategic aspect. And then, of course, you would argue if you succeed, you will boost your performance because of this risk-return profile. And so in a strategic asset allocation, if you talk to family offices and high net worth, which are unconstrained investors, which is quite important because banks, insurance groups, pension funds, and a few others are actually constrained by the regulations. They're limited in their freedom. But if you're unconstrained and you're a little bit more conservative than a Yale endowment, then you would see that the allocation is ranging between 3 and 11%. So that's what I said when I said we're on the radar screen, because above 1 to 2%, then you start really to be part of the overall thinking and this analysis. So let's have a look now. So how do you define then the program? What are the parameters? So academic literature has been digging into that. Some notes are more convincing than others, but one of the interesting things that they focused on, and which has been very convincing, is the size. And it's no surprise now to you. We said yesterday that if you cannot wait, you shouldn't get in. And now from what we said today is that if you're too small, you shouldn't get in at all as well, because you cannot really do a professional job. So the size of institution, and interestingly enough, the growth of the assets under management has been a defining parameter to identify the institutions who are able to allocate seriously to the asset class. Then another thing which has been very visible is if there is a problem, can you refinance yourself? One of the things we observe is that Yale and Harvard have been debt-free for virtually all their life as endowments. And in 2008, they could issue a bond with a AAA grade because basically they're very stable institutions with wealth which was tied up. And it would be very obvious that they would be able to refund the bond, repay the bond, the debt, and the interest. But this ability to refinance itself probably has triggered the ability to allocate so much to private markets. Okay, it still had consequences. I mean, Yale in 2008 has been suffering a lot. It's been documented. So if you want to read about it, but they had to scale down a lot of their ambitions in terms of campus investments. They had to ask some professors to leave. They reduced and delayed a lot of their programs. The only thing which they couldn't change were the scholarships, because some gifts to the endowments are driven by the fact that they give them. Otherwise, they would have lost it. But the rest has been scaled down significantly. Why? Because the university depends a lot. I think it's 1/3 of its budget now is depending on the endowment, which means what? It means that an unconstrained investor like Yale Endowment is suddenly constrained, because the institution relies on it to give it regularly 1/3 of its budget. And that's what I wanted to say earlier when I said that the Yale Endowment is so specific and particular. Even in itself, it's not the same than Yale 15 years ago. It was a nice to have cash pool. Now it's like it's needed to compete with the Ivy League schools in the US. And so it creates an implicit constraint, but that's beyond the purpose of today. So what are the constraints? The maturity of liabilities, if you have any, like you're an insurance group, then you need to match your assets and your liabilities. And so if you have maturities which are very much in the future, it will allow you maybe to put more private debt in your portfolio, or even potentially private real assets or private equity. Then, of course, there is the question of liquidity requirement. Do you have like recurring payments that you need to pay, and are they significant and highly constraining or not? Then you have your tax status that might prevent you to do some investments. We know, for example, that doing private real estate investment in the US can be very difficult because of taxes. There is a withholding tax there, which means that even if you're very successful, probably it's going to be challenging to get the full compensation of your risk because of the taxation in the US. Then there might be limits. For example, you might not be allowed to invest in some regions. That happens regularly still today. Some emerging markets are a no-go for some institutions. And then there is all these other limitations related maybe to environmental, social governance criteria, or other parameters which are defined maybe by the beneficiary owner if you're in a family office. And then what are the expectations, which is the third aspect? Of course, returns, risks, and the ability to match these liquidity requirements. So some time ago, AlpInvest and the World Economic Forum started to try to classify the fund investors and their ability to match let's say, liabilities that they have, even though it might be strange to think about liability with a family office, but significantly, you could list the fact that every individual has a life expectancy, so it creates some form of liability for the family office. It's not explained like this and expressed like this, but that's what it means, basically. And so they took this, and then they look at how does it match with private markets. And they ended up with this table, even though it's a bit old, it's still very much valid today, I think. And they made this effort to really think through and in a systematic way this kind of categories. And so I won't read it for you. It would be very, very boring, and we don't really have the time. But what I liked is that they tried to really give you an idea of what are the key points, and then what would be the allocation. And you see that, interestingly, life insurance, for example, doesn't really allocate a lot. And it's been, for example, a big surprise to me, because I would assume with this time horizon, then you can really load up on private equity and private debt, maybe not private real assets, but then you would really boost the performance. The reason for that is, of course, because of the regulations and also the fact that there is no incentive. I think that beyond this slide, what you have to think about is who takes the decision and what is the incentive. And half jokingly, I usually explain that, for example, for a pension fund manager, the job is to be a future pensioner himself or herself. The incentive to achieve your target return is very low. You don't get special bonus, but if you fail, you might be kicked out of your job. So incentives play a very significant role here. Of course, there are other factors, and you might argue that in the case of Yale Endowment, the CIO, David Swenson, who wrote 2 books, doesn't get a massive bonus, and he still designed this highly innovative asset allocation at that time and achieved a massive return for the university. But for one individual like him, there are hundreds who have no incentive and wouldn't, do it because they don't really get anything in exchange. And I think that's one of the key elements about an asset allocation. It's also about the operational setup and the incentive scheme. So at a certain stage, I started to look into asset allocation, and as you can see, not communicated was a big finding, not surprising. You get very little details. But so in 2013, and then I will show you more recently what happened. But in 2013, you would see that the asset allocation was still very much in the range of 3 to 4%. Of course, if you remember my bar chart, horizontal bar chart, it increased a lot for public pension funds. These are all public pension funds, by the way. And what was interesting is to see how they organize themselves operationally. So some of them would use, for example, an internal team. That's why I said that there is a Canadian model, and it's also true for Ontario Pension Fund and a few others. Whereas others would really get 1 or 2 advisors, and these advisors would have either a discretionary mandate or discretionary. And then custody would be separate, of course, for compliance reasons. So this is very interesting because I think, sorry, I mixed up my thought earlier. These are the percentage, and this is the absolute value. So what I said about the 3 to 4% is not correct. I apologize. I thought about the total asset class, not the leaders here, which allocate much more than the average. So what's interesting with this slide really is to see that they can disclose to a certain extent what they're doing, but they don't tell you the operational way, which is limiting us in terms of thinking and understanding what is a relevant asset allocation integrating private markets. Now, one of the advisors mentioned in this previous slide, which is Grove Street, tried to split it out and show the pros and cons. So there is always the question about control. We talked about it when we talked about fund of funds versus direct investments, and let's say economies of scale. And so, of course, the more you delegate, the more you lose control, but the more the group or the person you delegate to might actually be cost efficient because they might have multiple clients like you, and they can somehow share the cost or split them across a very wide pool of clients. An alternative is what they call commingled fund of funds, which is another approach. The first one is more tailor-made, so you have a platform and then you give a mandate. The other one is really a prêt-à-porter, as we call it in fashion, in French. It's off the shelf, right? And this is another approach where you split the cost with a lot of their clients, and basically you try to get the best deal possible. Then in the middle, there is what they call segregated or separate accounts. It's in between the control and the discretion. Of course, it has pros and cons. Here on this slide, of course, Grove makes a case for separate accounts. I don't blame them. It's just I want to emphasize the fact that there is pros and cons for everything, and here they try to highlight one. And then we have the in-house team. The problem is that this requires, as we said earlier, significant resources. So let's dig into this. Here, what I try to do is to quantify the cost and let's say the resources involved in 3 scenarios. Here you have fund of funds and mandate. Here, these 2, and I didn't put segregated account, but in the next slide you will see in-house team. So I made a very simple back of the envelope calculation. How much you would put, usually it's around 1 million in a fund. Actually, it's not true. Sometimes it's even 5 or even 10 or even more if you're in multi-billion-dollar fund. But let's assume that you don't necessarily want to invest in mega buyout, and then what are the thresholds to be considered as serious and to get special rights like co-investment rights, and it's usually around 20 million. Okay, there is usually I think I mentioned that yesterday. There is usually a kind of ceiling in which you cannot go above, and usually the fund manager says a single investor cannot own more than 20% of the fund, right? Otherwise, it creates a kind of systemic risk, and contagion risk are increasing for the other investors. Then what are the expenses? Well, you still need people, regardless if you invest in fund of funds or give a mandate, you still need to have an oversight of this kind of investment. And then you have an internal reporting, you need to do some selection, maybe take some decisions. And so it's quite important to keep this in mind. And it's very important when you read, for example, reports comparing co-investment performance versus fund performance. What I discovered, especially in academic literature, is that they tend to forget the costs associated with co-investment. And co-investment, for example, implies much more work from these shared human resources. And it's very difficult to isolate and quantify. But then, of course, co-investment, then you compare somehow gross returns because you don't factor in the indirect costs with net returns coming from a fund or a fund of fund or whatever program that you want, which is net, right? Even though there is a bit of work to do, but it's not the same intensity on the shared resources. Then I try to put the terms here and there. So of course, the fees are lower in a mandate and segregated account, but also you might have more work to do on your side, especially if you give a non-discretionary mandate. So the consultant will come to you and say, this is what we see this month or this quarter, which one do you want to invest in? And then you will have to do a lot of work by yourself. Whereas in a fund of fund, you just put the money and basically that's it. So the amount of work is much lower with investing in a fund of fund. You still have to monitor and report internally, etc. But as I said, the intensity of option 2 is much higher. Now let's have a look at option 3. Here you have, of course, much more to do by yourself, and then I try to quantify what are the human resources which would be involved, and then of course the material resources and the other expenses. I had a debate once with a famous professor. Maybe you heard about him. He's one of, if not the most famous professor, is at Harvard. His name is Lerner. Lerner wrote some of the best academic research on private markets. He's one of the very first to have started to write about it, and he also wrote excellent books. And then I was discussing with him at a conference once, and he said the worst part of the regime of pension funds in the US is that they have no budget. So he says, for example, CalPERS, if you talk to them, and I'm not sure it's confidential, so I can tell you, he says they have a budget to go to one trip per year. So it's usually they go to one conference. And he says, when I need to talk to them, I have to fly to California. They don't come to Harvard. And he says it's a happy chance that his brother is living next to Sacramento in California, so that he can come and visit them, because otherwise they don't even have the cost, the budget to fly in an academic specialist. So it's quite significant, this kind of budgets, and the rules on gifts and expenses and compensations mean that sometimes these institutions are understaffed and don't have the budget to operate. Why? Because they get benchmarked. It's also true in Switzerland. In Switzerland, there is something which is called a total expense ratio. So if you're a pension fund, you have to publish every year how much did you pay in terms of cost and fees, etc. And then if you take, of course, a pension fund which does a 60-40, their TER is going to be very low because they invest in maybe ETFs of bonds and stocks. And if you have one which invests in private market a certain amount, then their TER is going to be much higher. But of course, the TER is not return adjusted. So when you compare the two, you say, well, the second one is inefficient, or they're paying themselves too much, right? And that's a big problem, because as long as the TER will not be return adjusted, then the computation of a simple benchmarking will always favor the cheapest version, and the cheapest is not the most efficient, and it's certainly not the most performing. Now, the problem for calculating a return adjusted TER is that, as I said yesterday, our returns are generated over the next 3, 5, 7, or 8 years. And so it's not that simple. It's easy to criticize, as I just did, but it's much more challenging to produce a return adjusted total expense ratio. And that's a recurring problem. And that's why CalPERS get criticized. You know, whenever a journalist needs to make a headline and get a good coverage, he or she criticizes CalPERS because they're an easy target. They're the largest pension fund in the world. They have been investing in private equity for some time, and their results are not up to the expectations. And so it's easy to say that they pay too much fees and that they have been doing a bad job. So what are the results of this back of the envelope calculation? Well, as you can see, for a 500 million program with a fund of fund, this is the amount that you would pay in absolute value, and then a carried interest, which would range actually between 0 to 10, but often it's a positive carried interest because you need to incentivize the fund of fund manager. As for a discretionary mandate, you see that the budget falls, but be careful, there are some other fees that you would need to factor in. So since everyone is different, and the share of cost is split depending on the rules at every group, it's very difficult to get an aggregated estimate. Then for a non-discretionary mandate, it even falls further. But once again, remember, you have much more work on your side. And then you have all these things to take into account. And then normally I would, I don't know, yeah, the non-discretionary mandate is closer to the in-house, I would say, program. But for some reason, I should have calculated the in-house team. I assume that since I wanted to cut the slides, I relied on the non-discretionary mandate as a proxy for, yeah. The problem with the in-house is that you can calculate this, but it depends on the geographical region. So a senior investment officer in Luxembourg might have a different salary than, for example, in Switzerland or in France or in Germany. So the option 3 is actually much more challenging to quantify because it's location dependent. So that's why I didn't engage in that, because I don't know the cost of resources in Luxembourg, to be honest. So that's why I stopped at the non-discretionary mandate. So let's move on. We still have 30 minutes to top-down and bottom-up approaches. I like this part because it's very stimulating intellectually. I hope you will like it too. So this is basically what we refer to when we talk about how do we invest in funds, either as a fund of fund manager or a fund investor. So at the top, you have this very structured process, which is asset allocation, portfolio construction, portfolio monitoring, and management. So this is your view of the world. How much do we want to allocate to this region? How much do we want to be exposed to in terms of risk? What type of risk do we want to take? And then what kind of mega trend do we see? What do we want to be exposed to in that respect? What kind of value creation do we hope to capture? What do we believe in, right? These are very, very fundamental questions that chief investment officers and management basically discuss. And this translates into an ideal view of the world. Then comes the reality. That's the bottom up. Bottom up says, you would hope to invest, I would say something random. You would hope to invest in startups in Malaysia, right? That's your view. You think that Malaysia is great for a lot of reasons, and probably it is. It speaks English. There is a very fast growth. It's next to Singapore. There's some good educated population, which is very young. a little bit like Thailand, if you wish, but on top of that, probably a different political context. Okay. The problem is the bottom up will tell you we have nothing. There is no dedicated team here. There are some regional teams in venture, but so far we didn't see any meaningful investment in Malaysia. Or it might be that there is no real startup ecosystem in Malaysia. It might be just emerging, or it might be 1 or 2 deals per year. So your top down would tell you, let's go Malaysia. And the bottom up will come back and say, sorry, we don't have that. And that's the middle of the screen here, when the two converge, and you have to somehow make them coherent and work on that. And so you might end up with lists of fund managers that you pre-screen, and then you will see that some regions are like 30 names, others there is none. And that's going to be your main challenge. That's the process of asset allocation in private markets. And of course, you might argue, but would we have that in traditional wealth? To some extent, yes, but not to this level. Because if you want to invest in Malaysia, there's probably an index, or you can design something. You know, there's a stock exchange in Singapore. Probably some listed groups are covering Malaysia. Maybe some of them are Malaysian. So it's just an example once again. But you might get your exposure in a way or another. In private markets, sometimes you don't get exactly what you want, which is very weird, because a few slides back, I told you, it's great because it enhances your investment universe. That's true in theory, and globally it's true. But there is still some white spots on the map. I will take another example. I told you about distressed debt 2 sessions ago, and I mentioned the fact that distressed debt is an approach where you can invest into a company which is sound but has big problems. And the problem with distressed debt is that it might make a lot of sense for continental Europe. The thing is that the regulations are not ready yet. So your top-down perspective might say we should do distressed debt in Europe because of a lot of reasons, which are structural. It doesn't mean that the economy is bad or anything like that. It means that, I don't know, for a lot of reasons, some groups are going to have to change. And then it would be great to invest in this strategy, because the guys have the know-how to shift the business model, the focus of assets, and we can do it with reducing the risk, because it's a distressed debt approach. And the fact is that you have no equivalent here. And so the bottom up will struggle to just provide you with names, because the regulations are not adapted. And that's really something you have to work around. So what would you do? There is an alternative strategy, obviously, which is called turnaround capital. We briefly mentioned it in the first session, but it doesn't replace distressed debt. But it might be something we could look into. The other thing which has been developing is called non-performing loans, which is the equivalent of distressed debt, but adapted to the continental south, if I can use this expression. So the bottom up also forces you to be creative and to look around, not just, you know, in the specific box that you want to tick in your asset allocation. You might have to explore and say, well, we don't have it, but what if we use this as a proxy, or that, or what if this strategy is actually the local equivalent of what we're looking for? And so the overall process, as it's written here, is a process of circularity. You select, you source, you select, you invest, you monitor, then you take the loop back, and you're like, okay, I'm supposed to do it again. Would I reinvest in this? And this process is what actually ultimately should create the long-term performance of your program. Why? Because you're going to eliminate slowly the ones you're not convinced by, or fail out, or somehow you have splits from existing fund managers, new teams are emerging, and that's how you refine your program. So Yale is not only about the fact that they allocate a quarter to private markets, is that during the time where they ramped up their exposure, they learned a lot, and they started to select their fund managers and replicating the Yale allocation, actually, as Swenson said himself, for example, it's just 20% of the work. 80% is the bottom up. So it's very interesting because it's written in his very first book. He explicitly says that top down is 20% of his performance and bottom up is 80%. And the reason for that is because of this operational groundwork, which is very challenging to do, and the fact that the top down is not easy to implement as such. Okay, so essentially this is how it works. It works. So if we focus on this circular aspect, you would see that the sourcing is actually often you being approached by the fund managers. Then you have this selection process, which usually is a mix of desk work and in-person work. And then there is limited room for negotiation. Usually it's to exclude something which would affect you tax-wise or in regulations. For example, US pension funds focus on eliminating what they call unrelated business taxable income, UBTI. Basically, they should only collect capital gains. So whatever income the fund manager collects for the fund, which is not capital gain, has to be neutralized. And they make a very big focus on that because they don't want to lose their tax exempt status. And then there is the monitoring. And as you can see, the monitoring is very limited. You can either get out, so not reinvest in the next fund, or even sell on the secondary market if you're really, really unhappy. But remember the haircut that you take that I've been mentioning earlier when you sell your fund stake. You can voice your concern, but it can only lead you so far. And if you voice too much, you might be kicked out by the fund manager. So that's another thing. And remember, reputations matter a lot in this industry because of the lack of information. So if you're perceived as a complicated fund investor, the word can spread very easily. And so you might not be admitted in other funds and you might not even know why. Or you can stay loyal, but loyalty doesn't allow you necessarily to express your concerns, and it's not necessarily highly rewarded either. So it's a bit challenging to handle that, and that's why fundraising is so important. It's important for the fund managers who hate it because it's massive effort and it's resource consuming, but fund investors like it because that's one of the very few instances where they can ask questions, they can express opinions, and it's a little bit okay. And nobody will blame you to do that because you're supposed to do your job and assess the opportunity. So in a way, it's like ancient Rome when you had the triumph of Caesar, and you could go to Caesar when he would go back to Rome and be feted as the hero of the nation because he won another war. And then you could go up to him and tell him whatever you think that day. It's totally allowed, and it's not supposed to retaliate later. So it's a little bit the same for fundraising. You can go to fund managers that you don't know or you know and ask very tough questions to see their reaction. And if they're not supposed to retaliate or anything like that, you're supposed to do your job. The difficulty is to reconcile this exercise with the top-down, because top-down is shifting over time. There is some geopolitical events, macroeconomic concerns, political changes, cycles, and all of that means that you have to keep an eye on the long term while assessing the nitty-gritty of a track record, value creation, what we call the value bridge, where you see slice and dice how the fund manager did the work, as we mentioned yesterday. Okay, I'm conscious of the time. We have still quite a bit. Yeah. So, yeah. Let's take a few examples. These are not perfect, but they're from very reliable sources. So I took them. I'm not here to say they're good or bad. That's not the point. I'm here to illustrate. Okay. One is a very famous institution in Switzerland, only in Switzerland. It's an insurance group. It's the monopoly in Switzerland for accident. So you have only one group which insures everybody here for corporate accidents. It's called SUVA. Suva is a $50 billion institution, probably a bit more now. But when I took the snapshot, which was in 2016, that's the assets that they had under management. And you will see why I took the snapshot in 2016 in a second. And they manage also their own pension fund for their employees, and it was around 3 billion at that time. So they had more or less 7 executives which were doing private markets, and they had some in-house functions. So in a way, they were already in the option 2 or 3 that I was discussing earlier, but actually closer to option 2. And at that time, what they decided is to do this asset allocation, which is an average over these 5 years here. And as you can see, they allocated 6% to private market. Now that's very unusual. In Switzerland, which is a very conservative environment, most of the pension funds, for example, allocate less than 1%. They are 0.9% apparently, according to the latest data that I have, which are for 2019. We hope to get the figures for 2020 soon. And so it's very interesting because, for example, they had a separate allocation for loans and fixed income, or real estate and private markets. So they really had to split it down. And now if you look at the evolution over time, you see that it's been growing. So they were at around 1% in 2001, and they went up to 6% in 2014. And the thing that you can observe is that it's very difficult to actually stick to the allocation. Sometimes they were lagging, actually not that much. I've seen other institutions lagging by much more because it's quite difficult to deploy capital fast and maintain a certain level of quality. And sometimes they overshoot. Now, why do I use this example? First of all, just to show an example of asset allocation, which is public and identifies private market as such, besides hedge funds and all the other stuff, which is alternatives here. And the other thing is that in 2016, they took the very bold move to blend private markets in their asset allocation. So now you have equities, and you would have listed and private in the same bucket. And the reason why they did that, according to the person I had discussed it with, is because they said the problem is whenever you had a massive shift on the market, or whenever we wanted to fine tune, it was too constraining to separate our equity pockets or our fixed income pockets. So now we have this flexibility where we have an allocation, and within the allocation, we have much more freedom to operate. The problem is that now when you take a snapshot of Suva, you don't know what's really in their equity portion or their fixed income portion. But that's one approach, and I think it's interesting to see that they shifted dramatically from one to the other one. Then there is one which has been designed by, I think it's LGT. It should be mentioned somewhere. I know that's still Suva. That was the breakdown of their private market allocation, sorry. So here you would see that they don't do venture, for example. It was very interesting to observe that, even though they did turn around and distressed. And here, for example, they had no space for actual senior direct lending. So, and they put distressed for control in private equity and non-control in private debt. So everyone has his own perspective or views on the way we qualify the strategies. And what's very interesting as well is that they have not only the granularity of the investment strategies, but they have also allocation targets in terms of number of fund managers and then geographical locations. So I think it's quite interesting and illustrative as well. And so, of course, one of the key questions when you're doing asset allocation is, what's your benchmark to see if you're doing a good job or not? And what they did is that they took the vintage years, and then they rebuilt their program with the vintage years, and then they compare themselves with that, which is one approach. Sometimes you will see that some pension funds say, I want inflation plus X 100 basis points. Others have a much more complex approach, which is like they take a peer group of institutions which disclose their asset allocation and their performance, and they benchmark themselves with that. So of course, this has a lot of consequences in terms of incentive and performance. This is the LGT portfolio. So here, it's a typical asset allocation that they would suggest to their clients. It's a public slide, so it dates back a little bit. They don't give you the latest one for free, of course. And so here again, you see that their way to see the world is a little bit different. They, for example, don't have any venture again. And what they call special situations, we can assume that it includes maybe some form of distressed debt and turnaround, but it's not particularly explicit. And as you can see, the bracket can be fairly large depending on the region. And for them, the rest of the world is only Asia. So they don't put anything in other emerging markets. Okay. Here again, it's a very good perspective because it tends to be something that we observe often in terms of asset allocation within private markets, which are recommended by a large pool of consultants. I'm conscious of the time. We still have 11 minutes. I will try to go now into the current debate. And I already referred to some of it, but I want to go deeper. And then, of course, if you have any questions, use the chat or open the mic. So if we wrap up and conclude, what is the main challenge? Well, the thing is that investors don't like the J curve. They don't like to wait too long. They don't like the unpredictability of the J curve. And they don't like the fact that it's very difficult to manage in terms of commitment versus actively deployed capital. The other thing which is creating a problem is the fact that the value of assets doesn't increase or decrease together, right? It's funny because if you think about it, everybody loves lack of correlation, but dealing with the consequences of the lack of correlation is extremely challenging. So you would hope that your portfolio stays the same and then equity would drop, something else would go up. But actually your asset allocation says exactly the contrary because it says there is a percentage, and then it should stay stable. So there is something which is illogical, basically. Either you want a portfolio which doesn't move, right? And then internally the percentage should move so that the overall envelope doesn't. But if you have fixed percentages, it means that the value of your portfolio will move, right? It's interesting to see that it's very difficult to reconcile. And so the biggest problem for asset allocators with significant allocation to private markets is that we're very sticky. We move very slowly, quarterly, with a delay. And when we move very, very mildly. At the opposite side of your portfolio, you have something which moves significantly, rather unpredictably, sometimes drops for a very short time, sometimes drops for a prolonged period of time. And you need to deal with that. And the fact that basically you have an anchor in your portfolio and something else which is very significant, which is very difficult to anchor. And so the denominator effect basically comes from this. A sum and short over allocation to private markets because the basis of your assets has been shrinking, right? So the denominator is the sum of the value of all your assets, and the numerator is the individual asset you consider. So if private market is supposed to be 5%, and these 5 don't change, but the percent drops because listed equity dropped, then suddenly you become 7, 8, 9, 10. That's the denominator effect. There is another effect that we've been experiencing since 2009. It's something that I called, but it's not an expression from the industry, the numerator effect. Then the numerator effect is that you're running after your allocation. Why? The denominator has been increasing regularly and fast because the value of listed stocks has been increasing more or less every year over the course of the last 13 years, 12 to 13 years. And so since the value of the listed equity increases fast and regularly, it means that you have this basis which is growing, right? And private markets, as we know, is growing very, very slowly. the net asset values are growing conservatively, and the duration of investment is 3 to 5 years. So it means that when you say that you want to allocate 5% to private markets, the percent might increase fast. So the denominator might increase very fast and very long over a very long period of time, which means that the numerator has trouble to catch up. And you might try to force you to over allocate, but that actually makes things worse. Why? First of all, because you're pro-cyclical and there is a queue to get into funds. And second, even if you commit to a fund, it doesn't mean that the fund is going to call a lot of capital at the beginning, because there is a lot of capital available. They will raise more funds, bigger funds, but then they will make a capital call. Instead of being 3%, it might be 1% for a given amount to size the given opportunity. And so it means you're always running after your theoretical top-down perspective, and the bottom-up is struggling to help you catch up. And so the consequences are this. When you have, for example, a March 2020 event where you have this drop, and then you will see the denominator then shrink, and then technically your numerator is over allocated. And then this is the blue bars, which are the Nasdaq for ICSIC, and the GSPC, it's the S&P. And then when you have this rebound, you see that the basis re-expands a lot, and then your numerator again is trying to catch up because it doesn't grow that fast. And that's basically the two extremes that you're always battling when you're with private markets and you're investing in other asset classes such as listed stocks. Either you're under allocated, or more rarely you're massively over allocated. Now, one of the things, and I will finish on that so that we have enough time for Q&A, I promised you this slide earlier. This is something I did for clients some time ago, but it's still valid. And actually came from an initial graph which was done by Bain in one of its reports. What they did is that initially they started to compare the quarterly evolution of major stock indexes. Here you have 3 of them throughout the crisis of 2008 and 9. Okay, so you have the quarterly evolution of the indexes. These are the black and then the shaded gray in bars. And then in their report, they had an index of private equity, but I didn't really know how they calculated it, so I decided to do it myself. And I took the NAV of LBO funds in the US and Europe. And it's very interesting to see that, as you can see here, I should use my laser pointer, the indexes react to what happens macroeconomically and to market events, whereas the NAVs take some time to move. Here, they still continue to increase. Here, it's more muted for Europe. US still increases, even though it's been 2 quarters that the stock prices have been correcting. Then in Q3, a third quarter in a row of correction, US buyout fund starts to reflect it, even though Europe apparently still continues to grow a bit. And then you have the Q4, and that's the moment where you realize that you have to correct your NAV. So we can see that, but the stock prices also corrected a lot that quarter. But the funds here are reflecting on what happened during the year, okay? And then still correction in Q1 2009. And as you can see, the NAVs are not affected that much anymore. But what's very interesting is that when you had this rebound, so it was called a V-shape correction, basically, massive rebound in Q2, 3, and beyond 2009, you see that the NAVs are also moving up significantly, but not as fast as the indexes themselves. And this is very interesting because the mark-to-market is supposed to increase the tracking of these evolutions, but you see that the fund managers are still a bit of discretion. I think it's a positive thing, but the drawback is exactly the numerator and denominator problem that we're facing. Because you cannot really react the same way when stock prices do, then it means that you're always, let's say, challenged. And so why don't we react that much? Well, remember, stock indexes embed banks, car manufacturers, oil and gas, and a lot of other industries which are not necessarily the bread and butter of LBO investments. And so, for example, you will see that indexes at the moment correct a lot because of airlines, because of hotel groups, etc. But maybe these industries are not particularly heavily represented in the portfolio of buyout funds. And so it means that sometimes you have a discrepancy, but it's perfectly explainable, and you can insist on the mark-to-market. You're not going to mark-to-market your portfolio with airlines if you have no airline in your portfolio. You will mark-to-market with comparable groups, okay? So this slide, I think it illustrates this, and you can put a lot of pressure on marking to market. It's not going to solve the fact that you will have, on a recurring basis, a denominator effect and maybe a numerator effect and maybe sometimes a denominator effect, okay? So the last slide is to conclude on that and also show that at times you have net distribution. And that's also another thing which is challenging to handle when you do an asset allocation. You might want to put money in a fund, so you commit. They call you slowly, but they give you a lot of cash back because the conditions are very favorable. And so if you're sitting on an asset allocation committee, you see this massive wave of distribution coming your way. Normally people, when they get richer, they're very happy. But as an asset allocator, you're like, oh my God, I have even more problems because I have even more capital that I should recommit, and I have no exceptional opportunity to do that. And that's been one of the major issues recently. It's like fund managers do their job very well. They benefit from this environment, which is buying a lot of assets at very high prices. So they give you back a lot of cash, but then this cash, you have to reuse it, and it's making your life extremely complicated, okay? This I will go very fast. It's a bit of a perspective about different crises and how the denominator effect might change and the numerator as well. But I think it's better if we stop here. It's the end of the time, and I wanted to make sure that we can answer all the questions. Questions? So I put some conclusions, but I'm not sure it's particularly groundbreaking. I was just willing to wrap up saying the best way to avoid problems actually in asset allocation is to have a very disciplined approach from the top down. You should resist the temptation to be pro-cyclical and to have a program over 3 to 7 years. Yeah. So we have a question from Jérôme. Regarding the graph on your previous slide, don't you think the big move in the Q4 now for EU and US could be due to, to the year-end audit? Yes, indeed. We see that it's often the case. You wait a bit and then you act on what is really a long-term trend. And here there is a catch-up, obviously. And it didn't happen in 2020, surprisingly, as far as I understand, because the stock prices recovered in the second half of the year. So according to the latest statistics that I got, there was no massive correction in Q4. There was a stabilization in the US for US buyout, and Europe continued to go down because stock prices didn't have a good run last year. But it's not as visible as it was in Q4 2008, which was, I think, a very disturbing event for a lot of people. So there was a bit of wait and see, and then acting when we knew what was happening over the year. And the second part of the question of Jérôme is, most private equity funds are only audited once a year, and the auditor would want to book impairment due to the 2008 crisis. That's also true. Even though now apparently some fund managers also audit their quarterly. I know at least a few who told me so, but you're right. That was my conclusion as well. The reason why we see that so much in Q4 is because of it. Yeah. More questions? Yeah. So another question regarding COVID. We only noticed volatility in the first half of 2020. Don't you think the discount in value will come post-crisis? That's a good question. It's true. that we observed some volatility. It was reflected mostly in the second quarter because I think the crisis struck Europe, for example, at the end of March. So it was very tricky to establish new asset values as of end of March, I think. And usually fund managers have learned their lesson. We try to wait out a bit to see what's the noise or the unnecessary volatility coming from listed stocks and what's the actual signal, which is a long-term trend or a mid-term trend. So that's why we saw a correction in Q2. And the second half was a little bit more of a recovery in the US and sideways in Europe, let's call it like this. The impact beyond listed prices, I mean, the operational impact on portfolio companies is going to unfold. I agree with you, but it's just an educated guess now. I have no proof, but I think it's going to unfold as soon as governmental programs will wear off. We're going to see what's the actual damage in the economy, I think, as well. Yes. And so it's going to affect probably the portfolios, but it's not going to be visible from one quarter to the other. I think it will take some time to materialize, and the portfolios will be affected very differently depending on what kind of industry they're exposed to, what was the plan which was supposed to be implemented, and what type of strategy and asset they had in the portfolio. Thank you. More questions? No? Maybe just a word on this one, because it's an interesting one. So eFront published a very interesting research piece on the impact of crisis. And here again, it was to discuss COVID, but since we were so close to the recession, I assume they looked back. And what they looked at is the impact on vintage years. So this is multiples of invested capital, and then the actual crisis. And it's really interesting to see this dip here, right? And the fact that it affects vintage years very differently depending on how mature they are. Of course, 2002 and 2001 were a little bit touched, but not that much. And they actually more than caught up, maybe less 2001, but 2002 seems to have caught up. And others were much more affected. And some of them might not really have recovered to the point that they would have if there was no crisis. And the very clear case is 2005 and 7. And there is this outlier, which is 2006, which seems to be doing okay, actually. So even if you're caught with a vintage year, which is supposed to be very heavily affected, it doesn't mean that it's going to turn out as a disaster necessarily. And it probably depends on what kind of fund managers are active that specific year. So for us, with 2020, we could argue we should look back 4 years before and then 3, 2, 1. It's not particularly clear which one will be the most affected, if there is any consequence at all. It's much more complicated than that. Okay. More questions? So today was more intense again. Tomorrow, if the logic is respected, it should be a little bit less intense like yesterday, hopefully, so that you can breathe a little bit more. No question? I still have time. I know that you're very busy, but we can really take the time. No? Well, then I would like really to thank you very much for the very interesting questions, and thank Evie for her help in the session today, organizing everything as usually flawless. Thank you very much, and then I see you tomorrow.
Thank you, Cyril. Thank you all. I would say just to review everything and summarize your questions for tomorrow's session, as it is the last one.
Super.
Okay. Thank you all.
Thank you.
Here. Have a nice afternoon.
You too. Bye.
Thank you.